Right, now we continue the session. Now we look at the exchange differences. Exchange differences. First, we look at the monetary items. Exchange differences arising on the settlement date of the monetary items or the translating the monetary items at rates different from those at which they were translated on initial recognition during the period or in the previous financial statement. So shall be recognized in profit loss in the period in which they arise. Here what did I mention here? This is a timeline. So here the financial year starts, here financial year end, right? And the transaction has occurred on this time in this date. So for example 1st of March. So you may initially recognize the item on this date, and the item will be bring here at the end of the reporting period. Here when you translate this transaction occurred on this date, and your balancing figure will be on end of the closing date of the financial year. So the exchange rate on this date will be differ on this date. Sometime here your currency may appreciate or depreciate, so depending on that it may the loss or profit or loss may occur. And also sometimes you may purchase items on this date and you may settle after the reporting date, after the report in the future, right? So in this time you may encounter with two exchange rate differences. The first exchange differences occur at the the closing date of the financial year and the settlement date. Here there are first difference here and second difference here. So now we look at here the exchange differences arising on settlement of monetary items or on translating. Here first one, this is translation. The transaction occurs here, it will be translated to this figure. Transaction to translation. And this one settlement. This is also transaction, right? Here first understand the things. Initial recognition, it's mean the transaction has occurred, and this initial recognition will be translated at year end, the date, year end date, and then this transaction may be settled on this date in the future. It may be after the year end. So there are 3 dates as I told you earlier. Here this is the accounting period. So transaction occurred here. So this is a transaction date. It means initial recognition. So at this point you have to translate, and this is the settlement date. And from translation to this date and this. So that's what here mentioned. So the differences occur in this way, and this way. So here we have a simple example to understand the thing. Here we have 3 dates, right? This is accounting period starts 30th July, so say somewhat here, and year end here. This is year end. Here transaction has occurred, and settlement 1st of February 2010, next year. So it's after the accounting period. Here this is period is a settlement date, this is a translation date, this is transaction date. Here example, stage of exchange difference. Here the transaction is a credit. So on that date exchange rate was 140 spot rate, So amount of foreign currency, say for example they have purchased something, they have purchased US dollar, 10,000 US dollar, they have purchased inventory or something for 10,000 US dollar. That time the exchange rate was 140. So the transaction occurs on 30th July 2019. So this is called transaction. So we convert this value how? 140 into 10,000, it's equal 1.4 million. So this is what happened on this date. Now we move to the year end, this date. On that date the transaction has translated. So it's a monetary item, therefore they have to take the closing rate. Closing rate means the exchange rate at end of the period. So that is equal, that was 141. The same amount, 10,000 US dollar, will be translated into 141. So that will be 1.410 million. So how much loss? Due to the different exchange rate differences, 10,000 loss has occurred. 10,000 loss has occurred. So this 10,000 will be debited in the profit loss account as loss, transaction difference loss in the PL account of 2019. Again, now we move to this date. This date is the settlement date. Settlement. So this 10,000 will be settled on this date. On that date, it's a transaction, right? It's a transaction. Settlement is a transaction. So 142. So 142 into 10,000, it's equal 1.420,000. So 1.420 million. So again the exchange loss here, the difference here, difference between year end date to settlement date, that was how much? 10,000 loss. So that also will be credited in the financial PL account, profit loss account, in the next year. It's been the period in which the settlement has occurred. So altogether, from the initial transaction to settlement date, there was a 20,000 loss. This 20,000 loss is spread out in the first reporting period and the settlement reporting period. When monetary items arise from foreign currency transaction and there are changes in the exchange rate between the transaction date and the settlement date, and exchange rate difference results. When the transaction is settled within the same accounting period as that in which it occurred, all the exchange differences is recognized in that period. So it deals with only one period. However, when the transaction is settled in subsequent accounting period, as we discussed in the example, right? So transaction has occurred 2019, but settlement occurs in 2010, 2020. The exchange difference recognized in each period up to the date of settlement is determined by the changes in exchange rate during the period. So that's what we have discussed here. Now we have another example. X Limited borrowed rupees 500 US dollar on 31st December 2019. So date is very important. Which would be repaid on 30th June 2020, right? 2020. X Limited prepared its financial statement ending 31st of March. Exchange rate between the functional currency and foreign currency as at the relevant dates of this transaction, and here the transaction, this is what put the timeline. So transaction occurs on 31st here, 31st December, and year end on 31st December March, and settlement occurred on June. So it linked with 2 accounting period. The 1st of December, the exchange rate was 130, and at the year end, the exchange rate was 131. At the settlement date, exchange rate was 132. You are required to pass the journal entries including exchange rate differences effect on this transaction. Avoid interest implications. Here answer is very simple. Here the transaction occurs borrowing on this date. That time the spot rate is 130, and foreign currency, how much here? 500,000. So very simple how to convert this transaction into functional currency. So 500,000 into 130 equals 65 million. And so they translate the transaction on the year end. So translation of the loan balance, here the is 500,000. So that time the spot rate is a monetary item, therefore we have to take closing rate. So that time 65.5 million. So the difference, the exchange rate difference is 500,000. So that will be debited in the profit loss account as a loss. At the settlement date, that's the next year. So that time the exchange rate was 132. It's a transaction. So the settlement was 500,000. That time the functional value of the settlement in the functional currency 66 million. So therefore again the loss between these two, B and C, equal 500. It's also will be considered as a loss in the period 2020. Now how to pass journal entries? First, when they get the loan, here borrowed a loan of 500,000 US dollar at 1st of December 2011 at the exchange rate. So 500,000 into 130 here recorded, and the loss here recognized, and at the time of settlement the journal entry is like this. So you can easily understand very well. So I don't want to give more explanation on this. So we have to look at this slide very carefully, right? So for this transaction, so these are the journal entries. Now we look at non-monetary items. So previous slides talk about monetary item. Now we look at the non-monetary items. Recognition of exchange rate differences. Recognition of exchange rate differences. When a gain or loss on non-monetary item is recognized in other comprehensive income, for example, revaluations, any exchange component of that gain or loss shall be recognized in other comprehensive income. Likewise, when a gain or loss on non-monetary item is recognized in profit or loss, any exchange component of that gain or loss shall be recognized in profit loss account. Other SLFRS requires some gains and losses to be recognized in other comprehensive income. For example, LKAS 16 requires some gains and losses arising on revaluation of property, plant, equipment to be recognized in other comprehensive income. When such an asset is measured in foreign currency, paragraph 23 of the standard requires the revalued amount to be translated using the rate at the date the value is determined. That means fair value. We have to take the exchange rate at the time of valuation, resulting in exchange rate differences that is also recognized in other comprehensive income. So this is the summary of that. So regarding non-monetary items, gain or loss on non-monetary items. Gain or loss to be recognized on other comprehensive income if already have the revaluation things has connected with the other comprehensive income. Again, the exchange component of that gain or loss shall also be recognized in other comprehensive income. So other gain or loss to be recognized on profit loss account. Earlier they have recognized in PL account, so likewise this year also they have to recognize in the PL account. Exchange component of that gain or loss shall also be recognized in profit loss account. Now we have the same example as we did in the first part. Here the following are the detail of the foreign currency transaction of BAC Limited in the year 2009. Functional currency of BAC Limited is LC, say Sri Lankan local currency is Sri Lankan rupees. 2000 unit of goods purchased on credit from ABC Limited on January 2009 for foreign currency, hereafter referred as foreign currency, US dollar. For example, the value of item is 20,000 US dollar. Machinery purchased on credit from CBA Limited March 2019 for 30,000 US dollar. So cash paid on April 20%, for machinery 30%. So both of them are supplied in April. Fair value of inventory is 250 units in February. The foreign currencies mean US dollar 23,000, so not 2,300, and at the end of the year is 2,085. So recoverable value of machinery as at end of the year is 28,000. So it earlier 30,000 become 28,000. The average exchange rate are given below. The same example. Right now here, assuming that no depreciation is charged in the year of purchase, determine the value of monetary and non-monetary foreign currency items to be reflected in the income statement and financial statement of BAC Limited as at 31st December 2009. Pass the journal entries on the above transactions, including exchange rate difference effect on the transactions. So the same thing, right? The same question, and I have explained you the same answer, but now we are going to discuss how to record this. So here, what are the things? First, the cost of purchase 20,000. So we have to take the exchange rate on the day of transaction, first transaction, and we have to record the double entries, journal entries for the payment, settlement. So in these two dates, so the purchase on January, settlement happened on January, payment happened on April. So within these 3 months, there are some exchange rate differences. Due to that exchange rate differences, there may be some losses. That losses should be recorded in the profit loss account. So how do we account for that? And this is monetary items. So this will be recorded in the at the date of year-end date. So this is the same way we have to deal with as we do this. So this is non-monetary items. In that in where we have to compare fair value and cost, and we have to compare these two, and if there are any losses we have to uh, record in the profit loss account or other comprehensive income for the same thing, right? So here see the double entries here for the purchase of items. So purchase account and ABC account is a supplier account, right? Creditor. So how to record? So goods were purchased from ABC for 20,000. At the time the exchange rate was 140. So therefore 20,000 into 140, you can get this figure. And second, here purchase of machinery. So for 30,000. So that time exchange rate was 142. So you can record like this. And at the date payment, at the settlement date exchange rate was 142, but at the time of purchase the exchange rate was how much? Here 140. Exchange rate was 140, but at the settlement date 142. So how much difference? 2 rupees. 2 rupees difference, right? Here they are settled. How much they are settlement? 4,000. How we get 4,000? Here 4,000, right? Was settled at 142 per US dollar, and exchange loss of 10,000 was transferred. So it should be 8,000, no? That I check it. 4,000 dues settled at 142 per US dollar, and the exchange loss, it should be 8,000, right? It should be 8,000, no? 4,000. So at the time they are not. So how much they paid? Can you do the calculation, please? So they are,
sir,
yeah.
Cash paid at the April, no sir. April there was a exchange rate is 142.5.
Right. So we have to change here, no?
Yeah.
2.5 into
4,000, 10,000.
Very good. Right. Thank you very much. And in regards to the machine, so settlement was 142, and here they are paid 9,000. So 9,000 into 142.5 equal 4,500. Is it correct? So that time the exchange rate was how much? It was machine was purchased in March. So March exchange rate was 142. Settlement is 142.5. So only 0.5. 0.5 into 9,000 equal 4,500. That will be recognized as loss. And credit account will be debited, and bank account will be credited. So this is about for the transactions and losses. And here so they have purchased for 20,000. Already 4,000 was paid. At the year end date there will be 16,000 US dollar. So that is payable. So it's a monetary item. So therefore they have to take closing exchange rate. So closing exchange rate was 144. So 16,000 into 144 equal 64,000. How sorry. At the time of purchase, how much exchange rate? 100. How much? Yeah, 140. At the time of purchase, 140. 140. Now exchange rate is 144. The lost is 4 rupees per foreign currency. Then they are paying how much? The payable 16,000. 16,000 is payable. So 16,000 into 4, how much? 64,000 is a loss. Right? A loss. Likewise, the machine at the time of purchase 142.42. At the time of purchase 142, and the year end date, the exchange rate was 144. The difference is 2. So 2 into 21,000 equal 42. It's a loss. It's a loss should be recognized. And non-monetary items here. With regards to non-monetary items, so inventory was written down value how much? 350 to 324. So how much loss? Impairment is 49,760. So that will be recorded as a loss in the profit loss account. So inventory was written down, adjustment made on exchange differences. So that will be recorded here. And same as the machinery, right? Earlier it was 30,000, now it's become 28,000. So when they compare the fair values, right? Comparing the fair value and the cost, the difference also recorded in the PL account here.